Welcome back, everyone, to Money and Markets. As we've heard, quantitative easing affects all of the asset classes, stocks, bonds, currencies, and commodities, so there are a lot of ways to play it. Our producer, Jen Amos, asked all the Weiss research editors for picks and pans in anticipation of the Federal Reserve's policy decision. She has their responses now. Hey, Jen, how are you?
It's good to see you, Jamie.
It is good to see you. With a topic like this, I'm sure you're getting a whole range of responses. Was there one in particular that just jumped out at you?
Well, like you said, Jamie, if the next round of quantitative easing has the desired effect, it'll cause ripples across the markets. The dollar and interest rates on bonds will fall, and commodities like gold will inflate, along with other assets. Ron Rowland came up with one investment that would benefit from a couple of those trends. It's the SPDR DB International Government Inflation Protected Bond Fund. If the dollar falls further as a result of QE2, this ETF would benefit when its foreign holdings are translated back into the U.S. currency. Plus, we're already seeing other countries try to debase their own currencies to compete. If those competitive currency devaluations continue, WIP will win again as foreign assets are inflated.
Okay, which ETF is Ron panning?
He's one of many people who think quantitative easing will be bad for the financial sector. So he's telling investors to stay away from the SPDR KBW Bank ETF, ticker symbol KBE. As you can see from this chart, it's failed to retake its 200-day moving average. Ron thinks it's going to fall back and test technical support around $21 a share. And if that level fails, look out below.
All right. Another sector that may be in danger from quantitative easing is insurance, right?
Right. And Rudy Martin's pan is a giant in that industry. MetLife. He points out that if yields fall, investors will move out of low-risk, low-return products like insurance and into higher-income products. Just the anticipation of QE2 has taken a toll on MetLife. It already reduced its earnings forecast, and analysts lowered their own estimates and targets on the stock. Rudy thinks that if the Fed acts as expected next month, the buy ratings those analysts still have on MetLife will disappear, and it will go even lower.
Yeah, all right, so if investors are moving out of low-risk investments, which high-risk investments are likely to reap the rewards?
Well, more money will go into domestic junk bonds, but that market may already be overbought, as Mike Larson has pointed out in the past. Another area that may offer similar returns with less risk is the emerging markets. That's Rudy's specialty, and he's picking a mining company called Grupo Mexico. It's likely to benefit from a falling dollar and rising asset prices, especially copper. Rudy also expects a recent investment in oil exploration to pay off.
Jen, all of these picks are assuming here that QE2 will work as planned. It's going to drive the dollar down, it's going to inflate other assets, but Mike, Tony, Brian, as you heard in the show, they're saying that may not be the case here. Are there any picks for the opposite scenario?
That's a really good point, Jamie. We're seeing the markets move just in anticipation of QE2. And when the Fed actually does announce it next month, it might be a case of buy on the rumor, sell on the fact. In other words, QE2 may already be priced into the markets. In fact, Mike Larson thinks that's exactly what's happening, especially when it comes to the recent run-up in gold prices. He believes the short dollar, long gold trade is vulnerable to a short-term correction that could be violent. So he's telling his subscribers to take profits on contra-dollar plays, like the SPDR Gold Trust ETF. Of course, if the dollar reverses course and heads higher after the November Fed meeting, the euro will suffer too. So Mike's pick is the ProShares Ultra Short Euro, ticker symbol EUO. As we also heard from Brian Rich earlier, there's no real fundamental reason for the euro's recent strength against the dollar. So this inverse ETF is primed for big gains if the trend line turns around. Jamie, it really all depends on whether the next round of quantitative easing is big enough to affect the markets as the Fed wants it to, or whether investors are too optimistic about it already.
All right, Jen Amos, thank you.
Thank you, Jamie.
Coming up next, we'll tackle exactly that question. How big will QE2 be, and where will it be directed? Mike Larson is back with his answers, along with Steve Chapman of Weiss Capital Management, plus a closing comment from Martin Weiss. All that when Money and Markets returns. Stay with us.